Today, we're diving into a really powerful investing strategy. It carves out a unique path right between just buying index funds and trying to pick winning stocks. It's called factor investing, and honestly, it might just change the way you think about building a portfolio for good.
You know, for decades, the choice for investors has seemed pretty black and white. Do you go the passive route, just buy the entire market with a low-cost index fund, or do you go active and try to beat the market by picking the stocks you think are going to be winners? It's that classic dilemma.
But what if that's a false choice? What if there's a third way, a systematic, rules-based approach that's backed by a mountain of academic research? This isn't some fringe idea. It's the foundation of how many of the world's most sophisticated investors actually manage their money.
Okay, so to really understand this third way, we've got to start with the most basic question of all. What exactly is a factor?
Well, simply put, factor investing is a strategy where you systematically buy stocks that all share a specific, measurable characteristic, a factor. And the key here is that these traits have been proven, through tons of research, to lead to higher returns over the long haul. So it's less about making a gut call on a company and more about tilting your portfolio toward these proven drivers of return.
I love this analogy. Think of a factor as an ingredient in a recipe. You know, just like salt, fat, and acid all contribute to how a dish tastes, well, different factors like value or quality help explain a stock's performance. We're basically trying to find the recipes that have historically cooked up the most delicious returns.
So, what are these key ingredients? Well, all that research has zeroed in on 6 core factors that have proven to be persistent across different time periods and markets all over the world. So, let's crack the code on each one.
First up, we've got the OG, the one that really started this whole field, the value factor. You can just think of this one as the ultimate bargain hunter of the stock market.
The idea couldn't be simpler. Buy stocks that look cheap compared to their fundamental business metrics. Now, why does this work? It's largely down to human behavior. We tend to get overexcited and overpay for glamorous growth stories, and we unfairly punish boring, steady companies. But here's the catch. Value investing demands serious patience. It can underperform for years at a time, like it did between 2017 and 2020, before it comes roaring back.
All right, let's move on to our next factor. This one is all about finding those really resilient, incredibly well-run businesses. This is the quality factor, and I like to call it the compounder.
So with this one, you're buying companies that have strong profitability, really stable earnings, and not a lot of debt. For some reason, the market just seems to consistently underprice how powerful the long-term growth of these businesses can be. And here's a pro tip. When you combine quality with value, so buying a fantastic business at a fair price, you get what many people consider to be the most powerful two-factor combination in all of investing.
Now for our third factor, and this one is maybe the most fascinating because it's so driven by pure market psychology. It's the momentum factor, the ultimate trend follower.
The strategy is exactly what it sounds like. You buy the stocks that have been going up recently, and you sell or short the ones that have been going down. It works because of behavioral quirks, like how we tend to underreact to new information, which allows these price trends to keep going. But, and this is a huge but, momentum has the highest crash risk of any factor. When that trend suddenly reverses, it can be absolutely brutal. It's a powerful tool, but it should never, ever be used on its own.
Next up, we have a factor that's based on a company's sheer scale, the size factor, which you've probably heard of as the small cap premium.
For a long time, the data has shown that smaller companies tend to outperform their larger, more established cousins. This is probably because they're not covered as much by analysts and they're seen as riskier, so investors demand a higher potential return. Now, it's true that this premium has gotten a bit weaker in recent years, but what we've found is that size works best when you combine it with quality. The real sweet spot isn't just small companies, it's small, profitable companies.
All right, get ready for the most counterintuitive factor of them all. This is one that messes with a lot of people's heads. Meet the low volatility factor, or as I like to call it, the steady performer. The idea here is that boring stocks, the ones with smoother, lower price swings, actually produce better risk-adjusted returns over the long run. How's that possible? Well, it's another behavioral thing. A lot of investors treat high volatility stocks like lottery tickets, hoping for a massive payout. They bid the prices up so high that the future returns actually get worse. Low volatility stocks really prove their worth during market downturns because they tend to fall a lot less, and that protection is huge for long-term compounding.
And that brings us to our sixth and final core factor,
which is all about how companies reward their shareholders. This is the dividend yield factor, also known as the disciplinary.
The theory here is that stocks with higher but, and this is key, sustainable dividend yields tend to do better. Why? Because paying a dividend forces discipline on a company's management. They have to generate real cash to send out those checks. You just can't fake it with accounting tricks. But you have to be careful. A super high yield can often be a warning sign, a trap that signals a company in serious trouble. That's why you always have to pair this factor with quality metrics.
Okay, so we've got our 6 main ingredients. But how do you actually cook with them? How do you put them into a portfolio? Well, let's look at the 2 main approaches, focusing on a single factor versus combining them in a multi-factor strategy.
So a single factor approach is super simple and transparent. You just buy, say, the top 20% of stocks based on value. Easy to understand. The big downside, though, is that any single factor can go through these long, painful slumps where it just doesn't work. On the other hand, a multi-factor approach combines 2, 3, or even 4 factors into a single score. This usually gives you much smoother returns over time because the factors don't all move in lockstep.
Now, before you run off and start building your own factor portfolio, it is absolutely critical that you know about the common pitfalls. So let's quickly cover what to avoid.
Here are 5 big mistakes you want to steer clear of. First, don't chase the hot factor. That means piling into a factor after it's already had a massive run-up. Second, don't ignore trading costs and taxes. They're real and they can absolutely destroy your edge. Third, you've got to have patience. This is maybe the biggest one. Abandoning a factor right before it's about to turn around is a classic, painful error. Fourth, don't put all your eggs in one basket. Avoid concentrating your whole portfolio in just one factor. And finally, be really skeptical of those too good to be true backtests. A lot of them just aren't possible to execute in the real world.
All right, let's bring this all home. Let's turn all this theory into a practical investing blueprint that you can actually use.
The very first thing to get your head around is that this requires a major shift in mindset. Factor investing is not about trying to find the next Tesla or the next Amazon before everybody else does.
It's about building a smarter, more resilient system for your money. It's about tilting the odds in your favor, day after day, by systematically and patiently harvesting these well-documented sources of return.
And you can put these ideas to work right now. For instance, on a platform like Death Still, you can analyze the quality factor using something called the Piotrowski F-score, which is a 9-point checklist of a company's financial health. You can measure the low volatility factor using beta. Or you can even build your own custom screens that combine value, momentum, and other factors. This is where the theory really becomes a practical tool in your hands.
And if you want to go even deeper, you can explore over 300 free financial concepts and build up your knowledge with the learning paths over at fffinancestill.com. And of course, make sure you follow us for more explainers just like this one. And that brings us to our final question. And this one is for you. Take a hard look at your own investments. What factors do you think are truly driving your portfolio's returns, whether you realized it or not? Thanks for watching.